A single Bitcoin is worth more than most people make in a year, and nobody can agree on why. Half the financial world says it's the most important monetary invention since paper money. The other half says it's the most sophisticated gambling machine ever built. And here's the wild part, both sides have a point. So which is it? Because by the end of this video, you'll be able to answer that question yourself. And you'll never look at Bitcoin the same way again. The two camps, and why neither is totally right. Let's start by naming the two sides clearly. Camp 1 says Bitcoin is digital gold, a finite, decentralized store of value that protects your wealth from inflation, currency debasement, and political interference. Camp 2 says Bitcoin is pure speculation, a volatile token that produces nothing, pays no dividends, and only goes up because the next buyer believes in it more than the last one. The frustrating truth is that both descriptions are accurate at different moments. In 2022, Bitcoin lost 75% of its value in under a year. That's not how stores of value behave. But in 2020 and again post-halving in 2024, Bitcoin outperformed every major asset class on the planet. That's not typical of pure speculation either. But here's where things get interesting, because there's a third lens most people completely ignore. What store of value actually means and why gold didn't start there. People throw around store of value like it's a binary, either something is one or it isn't. But that's not how history works. Gold was speculative before it was stable. For centuries, the price of gold fluctuated wildly based on mining booms, colonial plunder, and war. It took centuries of global consensus before gold became the bedrock of monetary systems. Bitcoin is roughly 15 years old. The US dollar has been the world's reserve currency for over 80 years. Gold has held that monetary role for millennia. Judging Bitcoin's legitimacy by 2026 is like judging the internet in 1999 and concluding it was just a fad because companies were losing money. The thing you're watching might still be becoming what it's going to be. Now, this next part might surprise you, because the biggest shift in Bitcoin's story didn't happen on a price chart. Institutions changed the game, whether you like it or not, for years. The knock on Bitcoin was that it was retail-driven hysteria, Reddit traders, influencers, and meme investors pumping a digital coin with no fundamentals. That argument is harder to make in 2026. BlackRock, Fidelity, and some of the world's largest pension funds now hold Bitcoin as a portfolio allocation. Sovereign wealth funds in multiple countries have added exposure. This matters for one specific reason. Institutional investors don't hold speculative tokens in their fiduciary portfolios. They can't. Legal frameworks and compliance requirements prevent it. When a pension fund managing retirees' savings buys Bitcoin, it is by definition treating it as an asset with legitimate long-term value, not a lottery ticket. That doesn't make Bitcoin safe, but it does change what it is. And this is where most people make a mistake. They focus on the price instead of the structure underneath it. The 21 million rule. The one number that actually matters. Bitcoin has a hard cap of 21 million coins. That's it. No government can print more. No CEO can authorize a secondary offering. No central bank can dilute it during a crisis. This isn't a marketing tagline. It's baked into the code, enforced by thousands of independent nodes running globally, and would require majority consensus across the entire network to change. That consensus has never come close to happening. Compare that to the US dollar, which has doubled its money supply multiple times in the last decade alone. Or to gold, which we keep mining more of every year, slowly inflating the existing supply. The scarcity argument for Bitcoin isn't theoretical, it's mathematical. And in a world where every major currency is being printed at scale, mathematically enforced scarcity is not nothing. So why does this matter? Because scarcity alone doesn't make something valuable. Something else does, and it's the part nobody talks about. The belief problem, and why it's not as weak as it sounds. Here's the uncomfortable part of this conversation. Bitcoin's value ultimately rests on collective belief. If enough people stop believing it holds value, it holds no value. Critics use this to dismiss Bitcoin as pure psychology, a shared delusion propped up by greater fool theory. But hold on. The US dollar also rests on collective belief. So does gold. So does every fiat currency on Earth. The paper in your wallet has value because a government and its citizens agree it does. Take away that agreement, and you have fancy paper. Bitcoin's belief system is decentralized and code-based rather than government-backed, but the underlying mechanism is the same. The question isn't whether Bitcoin requires belief. Everything does. The question is whether that belief is durable. But here's where things get interesting, because durability is exactly what gets tested in a volatile market. Volatility, Bitcoin's biggest problem, or its growing pain. Let's be honest about what Bitcoin is not. It is not stable. It is not a reliable short-term store of value. If you put your emergency fund into Bitcoin in November 2021 and needed it in November 2022, you lost 3/4 of it. That's catastrophic by any standard. No legitimate store of value asset does that. But here's the nuance. Bitcoin's volatility has been measurably decreasing over time. Each cycle, 2013, 2017, 2021, 2024, the percentage drawdowns have gradually compressed and the recovery timelines have shortened. This is what maturation looks like in a new asset class. Early equity markets were wildly volatile. Early real estate markets were wildly volatile. Volatility doesn't disqualify an asset permanently. It characterizes its stage of development. Now, this next part might surprise you, because the halving cycle gives Bitcoin something almost no other asset has: the halving effect. A built-in supply shock every 4 years. The rate at which new Bitcoin is created gets cut in half. It happened in 2024. Miners who used to earn a certain amount per block now earn half that. This reduces the daily supply of new Bitcoin hitting the market at the exact moment institutional demand has been accelerating. Think of it like this. Imagine a popular restaurant that, every 4 years, halves the number of tables available, but the line of people trying to get in keeps growing. Basic supply and demand. The halving doesn't guarantee price appreciation, nothing does, but it creates a structural supply constraint that has preceded every major Bitcoin bull run in history. That's not a coincidence. It's the mechanism. So why does this matter? Because understanding the mechanism is what separates an investor from a gambler. Bitcoin versus gold in 2026. The comparison that settles the debate: gold has a market cap of roughly $15 to $17 trillion. Bitcoin, depending on the day you check, sits somewhere between 1 and 2 trillion. If Bitcoin ever achieves parity with gold on the same reasoning, portable, scarce, globally accepted, resistant to debasement, that represents potential growth of 8 to 10 times from current levels. If it surpasses gold, more. Gold also has industrial use in electronics and medicine, which gives it a value floor that Bitcoin doesn't have. Bitcoin, on the other hand, is infinitely portable, instantly transferable, and verifiably scarce in ways physical gold is not. You can't easily audit the world's gold supply. You can audit every single Bitcoin in existence right now, in real time, for free. These are not the same asset, but they are serving a similar function in portfolios: protection against the long-term erosion of paper money. And this is where most people make a mistake. They ask the wrong question entirely. The real question isn't, is it legitimate? It's, what are you using it for? Bitcoin in 2026 is not a savings account. It's not a checking account. It's not a stable place to park money you need next month. Anyone using it that way is taking on enormous risk and calling it investing. That confusion is where most retail losses happen. And it's also where the "it's just speculation" argument gets its best ammunition. Used correctly, as a small percentage of a diversified long-term portfolio, sized appropriately to your risk tolerance, held across multiple cycles, Bitcoin behaves differently. Its uncorrelated returns, its capped supply, and its growing institutional infrastructure make it a plausible hedge against monetary inflation over a decade-plus horizon. It's not for everyone, but it's not nothing either. And that distinction between tool and toy is entirely determined by how you use it. But before we wrap this up, there's one more thing worth saying, and it's the part most Bitcoin videos never actually tell you. What nobody wants to admit about Bitcoin in 2026, here it is. Nobody actually knows where Bitcoin goes from here. The analysts who called the top in 2021 were right, and they were also right in 2019 and 2023 when they called it over, and were wrong both times. The people predicting six-figure Bitcoin have been right once and wrong twice. The honest answer is that this asset is still early enough, still volatile enough, and still dependent on enough external variables, regulation, macro environment, technological disruption, that certainty is dishonest. What we do know is this: Bitcoin has survived every obituary ever written about it. It has survived exchange collapses, regulatory crackdowns, forks, bans, and bear markets. Each time it has come back to new highs. That's not proof it always will. But it is a track record worth taking seriously, especially when the alternative is leaving your savings in a currency that loses purchasing power by design. We started this video with a question: is Bitcoin a legitimate store of value, or is it just the world's most sophisticated gamble? The answer is that it's still becoming the answer, and where you land depends entirely on your time horizon, your risk tolerance, and whether you treat it like a tool or a lottery ticket. If this shifted how you think about it, hit like. It genuinely helps this channel reach more people who are trying to figure this out. And if you want to go deeper on where crypto fits into a real investment strategy, the next video is right there. I'll see you in it.